Milan, we are going to continue with asset disposals. I'll be doing example 4. In example 4, information is given differently. We are given the tangible asset note, and which is the note to the statement of financial position. You will realize that in this note, Lennon Buildings, I'll start with Lennon Buildings. Lennon Buildings cost at the beginning of the year is 3 million. However, Lennon Buildings at the end of the year will cost 2,100,000, which is weird. So you realize that the beginning of the year balance was greater than end of the year balance, meaning that our Lennon Buildings decreased. For grade 12, grade 11 and 12, and the grade 10 syllabus, please note that Lennon Buildings will not be depreciated. As a result, it will increase or decrease at cost price. So we need to calculate A there. For equipment, you were given cost at the beginning of the year of 258,000 and a carrying value of 184,000 rand. But we were not given accumulated depreciation. So we had to calculate depreciation by taking the cost price minus the carrying value, and we got 74,000 rand as our accumulated depreciation. When you compare the cost at the beginning of the year and the cost at the end of the year, you realize that equipment cost actually increased decreased from 258,000 to 240,000. So something happened during the year. It means that we actually sold equipment, or which is disposed of it. For vehicles, we've got vehicles cost, which is 780,000. Accumulated depreciation at the beginning of the year is 220,000, and the carrying value is 560,000. And the movements, we are told that vehicles were purchased during the year, but we don't have any information yet. So additions at cost for vehicles will be 360,000, and depreciation will be calculated for this current year. And you will know that the cost price at the end of the year has actually gone up from 780,000 to 1,140,000. Continuing with the information, they told us that unused Lennon Buildings was sold for cash. Okay, it was sold for cash. Okay, unused Lennon Buildings was sold for cash. At cost price to solve cash flow problems, meaning that the entity had cash problems. They didn't have enough cash, to be precise. This property was bought by Pedomam Pty Ltd, and they don't specify when. But anyway, that doesn't matter for now. Then they said the majority shareholder in this company is Betty Benson, the CEO's wife. So the CEO, his wife is the majority shareholder, basically owns more voting rights than all the shareholders. Okay. A company, a computer equipment was sold for 800 cash. So it was sold for 800 cash to the CEO, and the CEO is Ben Benson. Remember, the majority shareholder will be his wife. So it was sold to the CEO for 800 rand, and it was sold on the 31st of January 2013. They gave us the cost price of this equipment, which is 18,000. It was purchased on the 1st of October 2010, and they gave us the depreciation rate, which is 25% on cost. For the first year, you will realize that depreciation is 2,250 and accumulated depreciation is 2,250. Please note that that first year is the year that that equipment was purchased, all right, the year end. So that vehicle, that equipment for that year was used from the 1st of October. Let me just count. It's October, November, December, January, February, March. It was used for 6 months. So for them to get this 2,250, they simply took 18,000 and they multiplied it by 25%. and then they multiply it by 6 over 12. And that should give them 2,240. Let me just confirm that. Yes, it'll give you 2,240. So when you take 18,000, you multiply it by 25. I just want to confirm. It will give you 2,250 because that is the first year of using this asset. Obviously, depreciation for that year will be the same as the accumulated depreciation. To get the carrying value, remember carrying value is simply cost minus accumulated depreciation. The cost price of this equipment is 18,000. When you minus accumulated depreciation for first year of 2,250, it will give you the carrying value of 15,750. All right. For the second year, obviously that vehicle for second year for the year running from the 1st of March, 1st of April 2011 to the 31st of March 2012, you're going to use it for a full year. So when we calculate depreciation for that year, we'll simply multiply by 12 over 12 because we have used it for the full year. And that will simply, it should give us the depreciation of 4,200. So for the year ending 31st of March 2012, our depreciation will be 4,500. So I'm going to take 18,000. You're going to take 18,000 and multiply by 0.25. That will give you 4,500. Now you're going to add last year's accumulated depreciation with this year's depreciation to get this year's accumulated depreciation. By this year, I mean the financial year ending the 31st of March 2012. Okay, that will be this year. When we calculate carrying value for that year, I will simply take the cost price and minus this accumulated depreciation of 6,750, which will give me 11,250, which is the carrying value for the year ending 31st of March 2012. Now comes January 2013, which is the day we sold the asset. I highlighted it up there. So we sold the asset in January 2013. Now, when you have to count for that financial year, that 2013 financial year ending on the 31st of March 2013, we used this equipment from April, May, June, July, August, September, October, November, December, and January. I'm going to count January because that equipment was sold on the 31st of January, making it 10 months. We used it only for 10 months in the current year. So when you calculate depreciation for that year, I will apportion it to 10 months by multiplying by 10 over 12. And the depreciation for that year will be 18,000 multiplied by 25%, and then you multiply that by 10 over 12. Now it'll simply give us 3,750, which is the depreciation for the year ending 31st of March 2013, even though we calculated depreciation up to the 31st of March 2013. Accumulated depreciation will be 6,750 plus 3,750. That will give us 10,500. To calculate the carrying value, we'll simply take 18,000, you minus the 10,500. The carrying value on the 31st of January 2013 will be 7,500. Note that the beginning of the year for the 2013 financial year, the beginning of the year is the 1st of April 2013. That tells you that 11,250, this 11,250 here is the opening balance of accumulated depreciation for the year ending 31st of March 2013, because that year will start on the 1st of April 2012. So accumulated depreciation at the beginning of the year for this equipment that has been sold will be 11,250. We'll come back to that shortly. Right now, I just want to record vehicles. I'm going to start by recording vehicles first. Now I will start with my financial year, starting on the 1st of April 2012 and 31st of March 2014. Please note that we bought a vehicle on the 31st of June, if I'm not mistaken. Let me just go back to make sure that date is incorrect. It says the 30th. Oh, it is the 30th of June. My bad. So in this case, it will be the 30th of June. We bought a new vehicle worth 360. Excuse me. Note that the cost of vehicles at the beginning of the year was 780,000. You're going to add the cost price of the vehicle that we just bought, which is 360. It'll give you the total cost price of all vehicles at the end of the year, and that will be 1,140,000. How do we record this? Please remember that vehicles account is an asset account. This is the cars that we have in the business. So since it's an asset, just like any asset, it goes up on the debit side. Remember, this is the debit side. It goes down on the credit side, and therefore it will be plus minus. Okay, plus means it's going up, minus means it's going down. And remember that vehicle or any asset account will go up or down. It will go up or down at cost price. It'll go up or down at cost price. So this vehicle will go up at cost price. It will go up or down at cost price, which is the original cost price we recognize on that specific asset. We will start with the balance first. The balance of vehicles at the beginning of the year, which is balance brought down, it will be 780,000. Normally, remember your general ledger is prepared monthly for this topic, just to make sure that you understand the concepts. I will prepare the general ledger on a yearly basis. Okay. Now, please note that on the 30th, I don't know why I wrote the 31st there, on the 30th of June 2012, we actually purchased a vehicle, okay? And they did not specify. Let me just make sure if they actually specified how we purchased that asset. I will read that shortly. They say new vehicle costing 360 was purchased on the 31st of June 2012. So they didn't specify how that vehicle was actually purchased. But if it was purchased for cash, we're gonna it's easy because it means it will be bank and CPJ. If it was purchased on credit, it was going to be easy as well. You can write creditors control in CJ. But in this case, you were not told how this vehicle was purchased. Instead, they tell you how this vehicle is depreciated. So it is depreciated on diminishing balance method at 20% per annum. Per annum means annually, 12 months. And we're going to use the diminishing balance method. Let me just go back to the previous slide and how we're going to record all of these. Okay, to record this, we will actually debit our vehicles because we bought more vehicles. So we will debit it by bank or creditors control because we're not sure how it was purchased. So we're going to have CPJ or CJ, the amount will be 360. It will decrease when we dispose of, when we sell an invoice. In this case, there was no information about us selling, therefore we will just balance it off by having balance carried out of 1,140,000. Okay. Get the totals, meaning that our landing bills, not landing bill, our vehicles in the new financial year will be 1,140,000. Okay. Please note that that will be the cost of the new vehicle. So the cost of the new vehicle will be on the debit side, whether we purchase it cash on credit. Please note that had we sold the vehicle, we're going to have the cost price of the vehicle sold on the credit side. But in this case, we did not sell any vehicle. Therefore, that is why we've got, there's no reason for me to put that there. So I'll choose to take it out. Okay. How would we record this though in our tangible asset mode? This is how we'll actually record it. Um, I will start with land and buildings first, okay? Please note that with land and buildings, they decreased from 3 million to 2,100,000. It means we sold land and buildings. They said it's unused land, as a matter of fact, worth 900,000, which is the cost price of the unused land. So we didn't even make a profit on this. Please note that whatever comes here, it must be at cost price. You don't put in any selling price in this. It's either you put in the cost price or depreciation, nothing else. Selling price, no profit, no nothing. It's just the cost price and depreciation. Please note that for land and buildings, the cost price at the end of the year will be 2,100,000, which is the same as carrying value. Under land and buildings, carrying value from grade 10 to 12, it will be the same as the cost price, because from grade 8 to 12, we do not reevaluate land and buildings. We do not depreciate it. I know that normally the depreciation rate is around 2%, if I'm not mistaken. I stand to be corrected. For certain buildings, it will be around 2% or so. But for grade 10 to 12, please note that land and buildings do not depreciate. As a matter of fact, they appreciate in value, and that is the normal trend. The trend is that they appreciate in value. I know one of you asked me if they do depreciate. There's certain circumstances that will cause you to depreciate your building. But for now, please remember grade 12, grade 11s, grade 10s, we do not depreciate and then buildings. All right. I'm going to go straight to vehicles. For now, we'll keep equipment because equipment has disposals and it's a little bit complex. So I will just put in under vehicles 360,000, okay? And I will just leave it there because that is the cost price of the vehicle that we purchased. I'm going to go straight to calculating depreciation. In this case, our depreciation will be between the old and the new, okay? Not the remaining and the sold. Here is the old and the new. Now, when we depreciate this, we're gonna always start with carrying value, which is the cost price, minus your accumulated depreciation at the beginning of the year. And obviously that will give us the carrying value at the beginning of the year. The carrying value of old vehicles will be 780 minus 320, which is 560,000. So this is the carrying value of the old vehicles. How do we depreciate vehicles? We depreciate vehicles on diminishing balance, meaning that I'm going to take the 560,000 instead of the 780. If it was depreciated on cost, I was going to take the 780. But because it's depreciated on diminishing, I'm going to take 560,000. So you take that 560,000, we will have those vehicles for the entire year. And that's why I'm multiplying it by 12 over 12, which will give me 112,000. And then I'm going to go to this new vehicle. The cost price of the new vehicle is 360. But please note that this vehicle will not be depreciated, has not yet been depreciated, as a matter of fact. That is why accumulated depreciation on this vehicle is 0. And the cost price and the carrying value of the new vehicle will be the same because it is new. It doesn't have any accumulated depreciation. As a matter of fact, we're going to be depreciating it for the first time this year. So I'm simply going to take the depreciation method, which is the diminishing balance method. I'm just going to take my cost and multiply by the depreciation rate. And I have to apportion it because I've only used this vehicle. Let me just count for it's we bought it in June, so I won't count June. I will start counting from July. So it's July, August, September, October, November, December, January, February. That is March. I will count March because it's up to the end of March. So we used it for the entire okay, that will be 9 months. So I'm simply going to multiply this by 9 over 12, proportionate over 9 months, because we've used it for 9 months. And 9 months depreciation on this new vehicle will be 54,000. My question is now, what is the total depreciation on vehicles for the current year? The total depreciation on vehicles for the current year will be 112, which is the old plus the new, you add them together, it will give you 166,000, which is the total depreciation on all vehicles for the year. Now, the total depreciation on all vehicles for the year will be recorded in your tangible asset note. That is why for depreciation, I have 166. Okay, my movement under vehicles will be 360 plus negative 166, and that will be 194. Okay, how do I calculate cost of vehicles, especially at the end of the year? It is the cost of the vehicles at the beginning of the year. Cost of vehicles at the beginning of the year, 780,000, plus cost of vehicles purchased minus cost of vehicles sold. In this case, we didn't sell any vehicle, so our cost at the end of the year will be 780,000 plus 360, which is the cost of the new vehicle, minus 0 because we didn't sell any vehicles. So cost of vehicles at the end of the year will be 1,180,000. Accumulated depreciation at the end of the year. It is accumulated depreciation. Remember, accumulated depreciation, anything that goes to accumulated depreciation is depreciation. Okay, so it will increase by the depreciation amount, it will decrease by the depreciation amount. I'm going to start with accumulated depreciation at the beginning of the year, added with the current year depreciation, and minus accumulated depreciation of the asset sold. Okay, in this case, we didn't sell any vehicles, so it'll be accumulated depreciation at the beginning of the year of 220,000. You add 166,000, which is the depreciation for the year, or we minus accumulated depreciation of the sold at the date of sale will be 0 because we didn't sell any vehicle, giving us accumulated depreciation at the end of the year to be 386,000. So when you take the cost minus accumulated depreciation, it will give you the carrying value. So when you take carrying value at the end of the year, when you take the cost, you minus accumulated depreciation at the end of the year, it will give you this here. Or you can simply take carrying value at the beginning of the year, add it with the movements, and then so you'll be A plus B, it should give you the 754. Let me just check to make sure that everything is correct. It's 560 plus 194. It does give me that 754. What if I take 1,140 minus 389, 386, and that still gives me 754,000. All right. In the next video, we will be working on equipment, which is slightly complex. So I will leave that for the next video. Please check out the next video. Don't forget to subscribe and join the Google Classroom, and I will give you the link under the comments. Please feel free to ask questions by sending me emails, or you can simply comment with any question that you might have. And you may also recommend the videos that you would like me to record.